So official U.S. data shows that the economy grew a little bit slower than expected in Q2. Karina Mitchell has this from New York City.
Yeah, so the number was actually revised lower. It came in at 2.1% compared to 2.4%. But that number is actually still pretty strong. And it makes some economists scratch their heads because they were expecting to see more deceleration. The number is actually stronger than the 2% we saw in the first quarter. The one thing that this revision shows is that the consumer is still in a relatively strong position. Consumer spending actually went up by 1.1%. Compare that to business spending, which went up by 0.8%. On the flip side, we saw a decline in trade and spending in business inventory. So as I said, many economists expected to see more deceleration. They actually thought we would be in a recession by this point of the year or tipping into one. But despite seeing some weaker labor numbers just over the last, day and a half or so, the JOLTS number came in a little bit lower. The quits rate is lower. Hiring is slowing. We saw that from ADP figures where just 177,000 jobs were added. But despite all of these things, the economy is still quite resilient. And I spoke to one economist who said that he doesn't anticipate seeing a recession anytime in the next 12 months. But given if the fact that the Fed, sticks to one caveat, and that is that they do not hike interest rates. But the economist I spoke to says, the Fed shouldn't be stuck on that 2% inflation target because they could tip the economy into recession if they push too far. 3% is just fine. He also said that there's another thing that people should consider. Take a listen.
At the same time, I think that the money and the savings accumulated over COVID and because of the handouts of the Biden and the Trump administration, those amounts of accumulated money by the consumers seem to be ending. And I would say that probably they will end by Christmas. So one of the fuels of the overheating of the economy is being diminished or eliminated. And that's another reason for the Fed not to increase further interest rates.
So there you heard it. Everyone is going to be broke by the time Christmas comes around. That is natural disinflation. And so the Fed will not have to do anything more. That is what that economist said. Karina Mitchell, CGTN, New York.
And with that, we'll get market reaction. John Terrett has this from the exchange.
After the closing bell on the Wednesday session, a Dow Jones component and a very interesting company gave us their latest earnings. The component is Salesforce, which is one of those companies that doesn't really have any headquarters, but it's all virtual, and they will help you to run your business better than you could before you joined Salesforce. That's the idea. Anyway, it's a very interesting company. It always attracts a lot of attention, and Salesforce beat on the top and the bottom line, and the revenue was much better than Wall Street had been expecting, so the shares were up 6% in the aftermath of that news. And the cuddly one is Chewy.com, which will sell you anything you want for your pet via the internet, and they had a surprise profit, so the shares were up 3% after hours. On the markets, it's all about jobs, looking forward to the government jobs report on Friday. Today, the Dow was ahead by just over 0.1%, the Nasdaq 0.5%, and the S&P 500 0.4%. That's the fourth day in a row that the S&P 500 has been in the green, and the Nasdaq was lifted by names like Alphabet and Apple. In the Bitcoin space, well, it was down 1.6%, Ethereum 1.4%, and XRP down 2%. And later on Thursday, the earnings continue. We're going to hear from Campbell's Soup, which is based in New Jersey. It's a food provision company, obviously soup to warm your tummy. Dell Computers, one of the early names of computing, which is still going strong even today. And Smith & Wesson, the gun maker. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on all this, including the U.S. economy, William Lee joins us, chief economist at the Milken Institute. Good to see you, my friend. Where were we? Last time we talked, we were worried about inflation. Last time we talked, we were worried about the earnings. So fast forward to today, it seems like people aren't all that worried about it. And I don't know if you still feel the same way you did before.
It looks like the stars are aligning pretty well. The Fed is, I think, fairly happy about the fact that the labor market is starting to cool off a bit. And also the fact that the consumer is strong is something that the Fed kind of is metz about, because while they would love to have consumers enjoy their lives and have high income, wage inflation is still about a percentage point higher than something consistent with 2% target. Now, you know that it's very controversial whether the Fed should stay with its 2% target or not. But I think for them to have any kind of credibility going forward, they're going to have to hit 2% and then decide later whether or not they're going to maintain that as a permanent target.
Why does the Fed not care about necessarily the long-term rates? If you look at the 10-year Treasury rates, a lot of people panicked over that a little bit in mid-August when it hit 4.2, 4.3%. The idea was that if the cost of money over 10 years goes up, there's less reason to invest in anything, I guess, in the short term. Now, things have kind of moderated since then, but does the Fed look at those numbers?
They focus exactly on those long-term numbers because long-term cost of financing is something that businessmen talk about when they finance investment and business equipment, because usually business loans are somewhere in the duration of 5 to 7 years, and the 10-year rate is a good benchmark for what these longer costs of capital would be. And the reason why the Fed is worried is because once you get above 4% or so and inflation starts to drop back down to 2%, the real rate of interest, the real cost of capital really starts to shoot up. And that really could be a big drag on the economy. So the game is whether the markets are really fearing that inflation will continue, and that's why the rates are going up, or whether they're concerned that the fiscal deficit is out of control, and so the term premium goes up, the premium for longer-term borrowing by the government. Right. And if those are the reasons, then the real cost of capital, right, will go up. But if it's purely because of inflation, it won't go up. And that's why the Fed is so focused on where the long-term rate is relative to the inflation rate.
Economists like yourself have been talking about this one thing that I don't understand why it's controversial, but it's wage growth. We have seen wage growth in this country because the job market remains tight, and the wage growth is concerning, I think, if you're thinking about inflation, because you can't pay people more and not expect them to spend it. If you're going to pay people more, they're going to spend it. If they're going to spend it, you're going to get inflation. So what you're really looking for is people to make more money, but not necessarily spending it. It doesn't make sense to me.
No, what I think the Fed is trying to do is to say that here in the United States, the evidence is really mixed about whether wages are leading inflation or whether they lag inflation. More likely they lag inflation, unlike in Europe, where wages going up really is a source of further inflation. What the Fed would really love to do is people get paid just enough to catch up with inflation and their productivity increases. That's exactly the golden formula they're trying to get. Productivity is about 0.75% per year. Inflation, if it goes down 2%, that means that 2.5% wage growth is the level that's consistent with essentially maintaining 2% inflation. Right now, wages seem to be going about 3.5%, 4.5%, and that's why the Fed is worried, because if wages continue at that pace, then we have to have more inflation than 2%.
Isabella tells me I only have time for one more question, so we're going to make it a good one. This is one thing that myself and a lot of other friends have worried about. What if the economy remains kind of flat, 1 to 2 to 2.5% GDP growth, but yet inflation is at 3.5 to 4%? We would have sort of stagnant growth with the inflation.